I'll go ahead and turn it over to you and let you take it away.
All right, sounds awesome. Let us share the screen. All right, let's get that over to presenter mode. All right, Dan, we looking good?
I don't see it yet. Don't see the screen. On the bar of Zoom, there should be a green button that says share, and it'll have you choose the actual PowerPoint on your screen.
All right. Do you see that now?
I do.
All right. Let's see if presenter mode will work. All right. Is that in presenter mode right now?
It is, but we see the presenter mode screen instead of the main screen.
Got it. All right.
Do you have two monitors?
Absolutely. And it's barely enough.
Change the share to the other monitor where the other one is.
We got that.
There you go. That's it. That works. Take it away.
Awesome. Okay. I'd like to begin just with thanking Dan and the MFIN Summit staff, Stacy, Brandon. Thank you so much for hosting this, and thank you to all the attendees. The first event that we did about half a year ago was awesome. I love that presentation, and that was focused very much on much broader and deeper focus on syndication tax. And this Checkbook IRA, Checkbook QRP was just a subset of that. So I'm really excited today about taking a deep dive into this topic. As a CPA, I just got to put this up here. My attorneys require it. So of course, this is not legal advice. We're going to give you the best advice and info that we can possibly give you, but it's no substitute for getting information about your specific scenario. And just a minute about my background. I'm a CPA with a unique background that spans multiple disciplines. And so my focus is integrating tax and legal, or bringing all the components together to put you in control of your investments and reach financial self-determination. So as an introduction to today's subject, Checkbook IRAs using trust and LLCs, I think it's good to give an overview of the various tax-sheltered account types. I'm sure that by this point, many of us in the audience are familiar with the various tax-sheltered structures, but to ensure that everybody's up to speed and to get some definitions in place, let's kick it off with this. Broadly speaking, there are three types of tax-sheltered accounts. Some of them are retirement accounts in that strict sense. However, others are not. So as we can see, we've got them broken up as IRAs, QRPs, and other plans. So IRA, as you can see, stands for Individual Retirement Arrangement. And so although many of us are familiar with traditional IRAs and Roth IRAs, there are actually several other. There's a SEP IRA, which is a Simplified Employee Pension IRA, and then there's a Simple IRA. And these are all IRA-based accounts. However, traditional IRAs can be created by anybody, but SEP IRAs and Simple IRAs must be tied to a business. A spousal IRA is not technically another type of IRA. You're not getting, but it's a spousal IRA lets you create an IRA even for a spouse that has no income. So if you're married, you can create an IRA for a spouse, even if that spouse has no income. So again, we've got four types. They're all IRA based. Another group of plans known as QRPs, which is short for Qualified Retirement Plan. And again, there are many, many types of QRPs. We've just highlighted a couple of them here. Profit sharing, 401k, defined benefit, solo 401k, and money purchase. Some of these are really distinct types of plans. Solo 401k is not technically a distinct type of plan, but rather a 401k plan that only covers an owner-only business. So QRPs are qualified retirement plans governed by a totally separate set of rules vis-a-vis IRAs. And then there's other plans, a Coverdell IRA, also known as an education savings account, and there are health savings accounts. And as you may notice, 529s are absent from this slide. 529s belong to a totally separate group of plans, and those cannot be checkbook controlled. So anything that we discussed today can be applied to any of the accounts that we discuss here. So any type of IRA can be checkbook controlled. Any type of QRP can checkbook controlled, as can an education savings account and a health savings account. So we'll take a deeper dive into each one of these, but it's important to understand the various groupings. IRA, the keyword is individual. QRP, the keyword is that it's tied to a business. Okay, so the question is, why would you want to use self-direction and especially checkbook control? And we'll define those more clearly a little later. Why would you want to get control of a tax-sheltered account for investing in a tax-advantaged manner? You know, why would you not be satisfied with the options that are provided to you by your 401k provider or your brokerage? Well, the key thing, the top obviously, is the ability to invest in so-called alternates. A question that I get all the time is, what is different about this account? I know my IRA at Chase is a self-directed IRA. Well, it's self-directed in the sense that you can choose from anything that they make available to you. They give you a menu. They give you a large menu, stocks, mutual funds, and bonds, and you can self-direct and choose so long as it's something that they make available to you. But if you want to get into an alternative asset, which we'll just define as something that's not available on a brokerage platform, you need to get self-direction, true self-direction, and for total control, you're going to want that checkbook control. Now, why would you want to get this control? Why would you want to get into an alternative asset? The key things are, in alternative assets, you can leverage your knowledge, your experience, and your relationships. And not only yours, it's those of other investors. So if you're a passive LP in a syndication, effectively leverage the knowledge, experience, and relationships of the lead on the deal, of the syndicator and the investment sponsor. The stock market is a spectator sport. There's really nothing that you can do to improve outcomes. Scholarly research has consistently shown that when putting money in the stock market, the best thing you can do is just sit back and watch. You'll ride the waves, the volatility, and just take what the market gives and the market takes. Whereas in alternative assets that are not passive, that are not inherently passive, you can leverage your experience, your expertise, and that of the deal sponsors. And sometimes you'll get some kind of resistance that alternative assets are risky. Well, on the contrary, in the alternative space, you can get lower risk and higher returns. When you put your money in a deal with a sponsor that knows what they're doing, or if you know what you're doing, or at least you've done the due diligence to vet the sponsor, you can control the risks to end up with an optimized risk-return portfolio and a risk-return and risk-adjusted return. So in the stock market, that old corollary holds true. Risk is directly correlated with return. In contrast, you get into real estate, you work with the right folks, risk goes down and return goes up. So you can invest, you can get true diversification, you can invest in non-correlated assets, and you can directly control your investments. So these are things that are features that are available with any type of self-direction. With checkbook control, and what we focus on at ReSure, is getting your money into a bank account that you directly control. And that's what's known as checkbook control. So it retains its tax-sheltered status, but you have direct control over the money, and you got a deal, you write that check, you send that wire or ACH. And what are the benefits that you're going to achieve? Using this kind of structure, you're going to get increased asset protection. You're going to get anonymity. You're going to be able to more easily consolidate all your funds in a single place. So if you use a ReSure Checkbook IRA, you're going to be able to invest quickly. You're going to reduce your fees. You're going to reduce your paperwork. You're going to be able to get into deals fast and quick. And when you get into the alternative space, you have to start thinking like an investor. When you use Wall Street investments, then you're kind of passive. You go in, you click that mouse, you click, you buy, you sell, and you move on. But when you're getting direct control of your money to be able to put it into alternative assets using an IRA or 401k, you have to recognize that you've just made your IRA and 401k a real estate investor. So just as any real estate investor is cognizant of the requirement to move fast, get into deals, asset protection, anonymity, and be able to move fast and reduce your fees and think like and use it as a business. When your IRA is invested in real estate, it's got to take on that perspective. When you use a checkbook structure, giving you LLC protection, you get all those benefits. So the next thing is, why would you use a checkbook QRP? A checkbook QRP vis-a-vis a checkbook IRA. The checkbook QRP will allow you much higher annual deductions. It will not require a custodian. It will not require an LLC. An LLC is an option. So again, if you choose to, you can add an LLC to enhance your asset protection and ease of transacting, but you can get that checkbook control tax-free, and it's one account that will include Roth, after-tax, and pre-tax components. But the ability to put $122,000 in there does not mean that you have to. So you've got total flexibility. And of course, one of the biggest benefits is the ability not to think about UDFI when investing in real estate. So now that we kind of get a high-level view of what the benefits are and what you can achieve using either a checkbook IRA, checkbook QRP, or checkbook 401k, let's kind of dive into the nuts and bolts and see how these are structured. And the structure will vary depending on your objectives and your financial profile. So the key thing to be aware of is when structuring these things, a starting point is distinguishing between trusts and LLCs, because we use both trusts and LLCs for these structures, but they each have pros and cons. And what you can do, the legal protections that you'll get, your ability to navigate IRA and 401k law varies based on the entities that's used. So what is an LLC? Not much that we've got to say here. I think we're all somewhat familiar with LLCs. An LLC is a limited liability company, which is a statutory legal entity that is brought into existence through filings with a jurisdiction Secretary of State. So LLCs are a statutory entity. That's a key component that we want to bring out. It is an entity. It stands apart. An LLC can exist without having a manager. An LLC can exist without having a member. It's a legal entity that is brought into existence through a filing with the Secretary of State. And we've got 51 domiciles in the United States. So we've got 50 states and DC. Each domicile has an LLC law. And an LLC is brought into existence through a filing with that state jurisdiction Secretary of State. It's not a contract. It's not something that I create with you. Investors create amongst themselves. You go to the Secretary of State, and based on the state law, a legal entity is created, very much like a corporation. So an LLC is a distinct legal entity. And once that legal entity is brought into existence, it can get an owner, what you call a member, and it can have a management structure. So it can have managers and owners of that legal entity. Similar to a corporation. Of course, it's not exactly alike, but for our purposes, the concepts are very, very similar. In contrast, a trust is fundamentally different than an LLC. Here we've got lots of words. That's because LLCs, kind of broadly recognized. However, trusts are a bit more mysterious, a bit more mystique associated with trusts. So let's elaborate here just to talk about what a trust is, how a trust comes into existence. A trust comes into existence primarily through an agreement, a trust agreement. A trust, again, will have a settlor or a grantor, a trustee, and a beneficiary. So there are three parties to a trust agreement. A trust is not created by filing something with the Secretary of State. A state may have trust law to figure out how to apply, and how to govern these contractual agreements, but a trust is inherently a contract. It's an agreement. It's not an entity. And as you can see here, a trust is created when a settlor transfers assets to a trustee to hold for the benefit of one or more beneficiaries. So in a trust, the one that puts the property into the trust is called a settlor or grantor. And then that asset is held in trust by the trustee for the benefit of a beneficiary. And these can generally will be three separate parties, but they don't necessarily have to be in all scenarios. So the beneficiary has what's called equitable title, usually, and the trustee has legal title. So the trustee is the one that can sign contracts, that can convey. For legal purposes, they're on title. But the rights to enjoy the property, the rights to all the benefits of the property and the assets that are held in trustee belongs to the beneficiary. So to kind of outline how this would come into play in an IRA and how we would determine what to use, let's move into the IRA structure, figure out what your traditional self-directed IRA and QRP is, and how we can get checkbook control for you. So with a self-directed IRA, we'll get back to these later. And we'll focus on IRAs first and transition to QRPs if we have time. IRAs are brought into existence by the tax code. And the tax code requires that IRAs have a custodian. It's something that's in the tax code. It's got to be a financial institution that's regulated by banking authorities. Now, once Congress created these tax incentives for creating IRA accounts, various industries emerged to help people take advantage of them. So in this diagram, we've got, on the one hand, the brokerage custodians, and on the other side, we've got the self-directed IRA custodians. And a ReSure Checkbook IRA exists within that realm. So this is a high-level kind of bird's-eye view of the industry. And to talk about the evolution of the industry, let's focus for a moment on the brokerage custodians. So the most well-known ones among those are your Schwab, Fidelity, Vanguard. And with these custodians, you can go ahead and you get a free account. But you may find in that free account that they're going to restrict you to investing in whatever assets they make available. However, are these accounts truly free? Very seldom is anything ever free. So we kind of know that if we're offered something free, it's to pull us through the door where we can actually engage in some sort of business with them that will generate fees. And the brokerage space, the Wall Street space, has a plethora of visible and hidden fees, which are very, very difficult to decipher. In particular, if you've got a company 401k plan, you're probably paying between 1% to 3% of your assets in fees, whether or not you know that. We've got a link on here to an SEC page that gives you some insight into some of the fees you'll be paying. However, when you want to buy stocks, it is very easy. It's all automated. And the key to understanding what this business model is about is recognizing that these brokerages are in the investment business. They make money on investments. So whether you're going to buy a mutual fund that they provide and they created and they're going to make fees there, or you're going to buy somebody else's mutual fund on their platform, they're going to get trading fees. They're going to get 12B1 fees. They're going to get kickbacks. there's a range of fees that they're going to be getting through the investments. And the administrative component of this is really easy. It's automated. The liquid security space has been phenomenal at making it just easy to do things. You click the mouse, it happens. It doesn't require any human intervention. So it makes it really easy, but that is also why there's not that much opportunity on these platforms, because anybody can invest there, and everybody can analyze the stock, and anybody all over the world, wherever you may be, you can click and buy and sell and analyze that market. So in order to provide people true IRA services, a self-directed IRA industry emerged. And these are custodians that are not in the business of providing investments. They don't make money on your investments, and what they do is administer assets. So they'll let you invest in a much broader array of asset classes, generally not the full gamut of investments are allowable, but nearly everything. And as you can see here, the way the structure works, the traditional version of it, you've got the custodian, and if you want to have a tax lien investment, a syndication investment, you know, every single one of those assets is, so to speak, custodied by the custodian. And the way they do that is they sign all the documents. All investment documents have to be processed by them. Every investment transaction is processed by them. Money goes out, they send the money out. Money comes in, it goes to them. And logically in this space, accounts are not free because they're not making money on your assets, and they actually are doing something that's very labor intensive. They're reviewing reams of documents to process and sign in order to get your money into the deal that you want. So this was a great benefit to folks that want to get into alternative assets and recognize the great value that they present. However, you can see, I mean, it's just evident the inherent limitations in this space and how cumbersome it is. If you're going to have somebody else processing every single one of your deals, it's going to take time. They're not going to give you a one-to-one relationship. So they're working with thousands of investors, and they've got a small customer service team that has to process every single document. And they're looking for those T's to be crossed and I's to be dotted. And if that's not done correctly, they kick it back to you. So everything takes time. Everything incurs fees. And you can miss deals. You can incur substantial fees. So one of the ways they charge you is based on the number of assets you hold. So every single asset that you hold will incur an additional fee. If you want to do one deal and you're going to forget about it, then this model works well. But if you think you want to do multiple deals, or you're going to want to do something that requires you to move quickly, this route is not going to work well for you. And in fact, we've had clients that have come over to us that have saved tens of thousands of dollars in annual fees instantaneously. They've gone from paying tens of thousands to paying $200 per year. And they get greater control than they ever had. So how do we give you that checkbook control structure? How are we going to get that money into your hands but retain its tax advantage status? So there are a couple of ways that we do that, but this diagram provides a really, really clear model of how it's done. As you may recall in the prior slide, you saw that an IRA custodian can invest in a private company on your behalf, right? So amongst the many asset classes that are available, you can have real estate, tax liens, private loans, hard money loans, crowdfunding, startup investments. So all sorts of privately held companies are available. So the way we get you direct control of your money is by creating a private company investment. And we tell the IRA custodian, and we work with many of them very closely, is we are going to make a private company investment. Take all the money that's in the IRA account and move it into this private company. Now, once the money is in that private company can do all the investments that it chooses to. So rather than have the IRA custodian control each asset, from the custodian's perspective, we end up with a single asset. It's that private company. And once the money is in there, that company can be run like any other company. And to kind of highlight how this works, even in a traditional account, if you buy Amazon stock, Amazon does what it wants. If you buy Tesla stock, Elon Musk does what he wants. It's kind of out of the purview of the custodian. The custodian doesn't know, and the custodian doesn't want to know. So once the money is in your private company, you're able to get direct control, completely eliminate all those costs. So with our relationships, for example, you can end up paying a low flat fee that's as low as $125 per year, no matter the size of your IRA. You can have 100 assets and your IRA can be worth $100 million. It's just $125. And that comes along with the increased flexibility, the ability to transact instantaneously because you're holding the checkbook. You just wire the money out, the ACH money wire out. No need to have custodian countersignature. And some of the people that we work with most closely are investment sponsors and syndicators that recognize that when they need to get money into a deal and they need somebody to put things in place quickly and be able to repeatedly fund deals, getting the checkbook structure in place is absolutely crucial for them to get their deal done and get funded in a timely manner. And it's worth discussing a bit here some of the distinctions between a checkbook LLC structure and a checkbook trust structure. So you may recall the distinction that we had between trusts and LLCs. So when we do it as a private company investment, we're generally going to use a limited liability company. And that's very important when you're investing in real estate, because when you're a real estate investor, you have to start thinking about asset protection. And an LLC will provide you with asset protection. In contrast, trusts are contractual agreements and generally provide very limited to no asset protection. Trusts can be anonymous, but they do not provide statutory protection, which means that, say there's some sort of liability event that occurs within an LLC. Well, the owner of that LLC will be protected. And vice versa, if the owner of an LLC has a liability event, the assets in the LLC may be protected because the LLC is a distinct legal entity. In contrast, a trust is a contractual agreement, and it is not a distinct legal entity. And in most scenarios, a trust provides no legal barrier. It can help you with anonymity, meaning keeping your assets private. But in the event that there is a lawsuit, it does not provide a legal shield. So that's one key distinction that derives from the distinction that we outlined earlier. So when you're investing in a hard asset that can generate liability, or if asset protection is important to you, you generally want to use an LLC. Another thing that comes into play is who can be the direct manager of the checkbook controlled assets. Well, when we use a private company investment, nearly all our clients have the IRA owner being the company officer that directly manages the assets. But a trust is not a legal entity. A trust is a contractual agreement. And as we're all well aware, and we'll take a deeper dive at that in a moment, just want to kind of cover the high level right now. The IRA owner is a disqualified person to his IRA. He cannot engage in any business directly, be a counterparty to a transaction with his IRA. Therefore, we strongly discourage our clients from being the trustee of an IRA-owned trust. So when using an IRA-owned LLC, we're very comfortable with the IRA owner being the manager of that entity. However, in a contractual agreement, a trust agreement, which is an agreement between the IRA and the trustee, we strongly discourage the IRA owner from being the trustee because that may run afoul of the prohibited transaction rules that do not allow an IRA owner to contract and be a counterparty to a transaction with his IRA. So here is a more granular look at how a checkbook control structure is implemented. And as you can see here, we've got the custodians got to be here at the center of things. Money contributions flow to the custodian. You consolidate all your funds at the custodian, and then we send them to the LLC bank account. And of course, there's nuance associated with each one of these steps. And at ReSure, we're here to assist you from start to finish to make sure every single step of the way is done compliantly and smoothly. And no discussion about self-directed and checkbook IRAs or QRPs is complete without discussing the prohibited transactions. We want to make sure everybody's aware of these limitations before they get involved with these accounts. And the prohibited transactions makes it sound a lot more onerous than it is. But at a very high level, what these are telling you is you can get into any asset class that you choose. However, your IRA or QRP cannot transact with certain disqualified persons. And those disqualified persons, as you can see here in the center column, are the IRA owner, the IRA owner's spouse, parents and grandparents of the IRA owner, children's and children's spouses, and as well as any business entity in which there's 50% ownership combined among those disqualified persons. But as important as it is to know who is disqualified, it's important to know who's not. So not everybody that you've got a relationship with is a disqualified person to your IRA. Siblings, in-laws, nephews, nieces, friends, aunts, and uncles, and of course, anybody else out there. There's a huge world of opportunity, but you've got to be cautious when using IRAs or QRPs not to run afoul of these rules and not to transact with any of these disqualified persons. We're going to kind of move on past these rules in order to take some more, focus more on today's topic. So what would the pros and cons of a checkbook control be? So the pros, as you can see here, you can reduce fees, ease of transacting, reduce paperwork, asset protection, privacy. You can participate in auctions and sheriff sales, REOs. Those are kind of deals that need instantaneous access to cash. You can invest in assets that custodians can't hold directly. So cryptocurrency, cannabis, or foreign assets. So there are a range of assets that are not going to be directly available if you use the traditional self-directed model. But if you've got the checkbook control, then you can hold those because you're going to have the access to that money either in the trust or the LLC. But of course, everything that has so many pros, as a general rule, there certainly are potential cons. So biggest hurdles that people encounter are the initial setup fee. It may cost a little more in the first year to get the checkbook control structure in place. And then there's a whole new set of questions that you have to think about when setting up a checkbook control structure. Where should I put the LLC? As you recall, there are 51 options, and it's not one size fits all. Naturally, any one size fits all approach, always putting the LLC in one state is not going to be a good fit for everybody, and in most cases won't be the best fit for an investor. How to get the bank account opened. Once you've got direct control of the assets, there is a greater possibility of engaging in an inadvertent prohibited transaction. So we spoke about those rules before. Well, when the custodian holds the money, you can't, although there's no guarantee you won't engage in a prohibited transaction, you can't instantaneously write that check. It takes time. So when it takes you 2 to 3 weeks to process an investment, you have time to pull it back and mull it over. But if you've got direct control of the money, you could inadvertently do something with the inability to retract that. Furthermore, there is maintenance. When you have a limited liability company or a trust, may each require a certain kind of maintenance. If it's a limited liability company, each state has different requirements to maintain the good status of that entity. And for a trust, while there are no statutory requirements, of course, you want to make sure your trust is being run properly on the up and up, but you will not have any annual fees to the state. However, at ReSure, when it comes to running these checkbook control structures, we aim to completely eliminate and give you the pure upside of having a checkbook controlled IRA, checkbook controlled QRP, or 401k. So on the IRA side, we're there every component of the process, from custodian selection, leveraging our partnerships and relationships for attractive pricing and streamlined account setup. We're involved in the domicile selection. We're involved in the bank account. We're there to help you avoid those unknown unknowns. Where we see the greatest pitfalls in this space, especially with folks that may be taking a do-it-yourself approach, is that there are just too many unknown unknowns, those gotchas that only people that are immersed in the space and experts in the tax code governing this are aware of. A Google search will not uncover all the information that you need, and custodians' information will not either guarantee that you'll avoid prohibited transactions. So every single client that works with us gets a comprehensive education regarding the rules and what they have to do to maintain compliant. With regard to the LLC maintenance, that's something we can assist with as well. And our pricing is absolutely unbeatable. So with all our clients, they're seeing savings in year one. Even though they're using a checkbook structure, the pricing is so attractive that working with us, they're coming out ahead and just in the pure dollars and cents perspective, even in year one. And with all that in place, you get the pure upside and perhaps even come out ahead with regard to compliance, control, flexibility, and cost of having a checkbook IRA structure. And to talk for a moment about a checkbook 401k. Now, the checkbook 401k is a type of checkbook QRP, and it's distinct from the IRA because there is no tax code requirement that there be a custodian. So a 401k QRP is essentially a trust. That's what it is. It's a trust that's created, and you can be the trustee. And likewise, you get direct control of the money. But the key thing to be aware of is that any type of QRP must be tied to a sponsoring trade or business. And not every type of income-generating activity can qualify as a trade or business. And this is one area in particular where over the last year or so, we're seeing lots of pitfalls. People getting 401ks or QRPs that do not qualify for them. So while a QRP is generally is preferred to an IRA when applicable, you've got to use the structure that is compliant from your perspective and based on your financial profile. And as discussed, within a QRP, we can also create an LLC. And although you can have the checkbook control without having an LLC inside of a 401k, you would want to use the LLC for enhanced asset protection and anonymity. So we don't require that our clients do that. We offer as an enhancement. We create an LLC inside the 401k trust, very similar to the LLC that would be created inside of an IRA, and hold all assets within that LLC. And to cover some of the benefits of using a QRP 401k vis-a-vis an IRA-based structure, and again, we'll just do the bullet points today. It's not the primary focus. There's no custodian required. You can get far greater contribution amounts into a QRP. You can use advanced tax strategies incorporating pre-tax, after-tax, and Roth accounts within a single plan. you've got a loan option. So you can technically put in a contribution, get the tax deduction, and then pull some of that money out for your own benefit, totally tax-free, and you will not have UDFI on leveraged real estate investments. But something that's worth mentioning is that UDFI on leveraged real estate in an IRA is never a factor in choosing what kind of structure you should have, a QRP or an IRA-based structure. If you qualify for the QRP based on your financial profile, you would go with the QRP. If you do not, we would go with an IRA-based structure. And the UDFI, while it's better not to have it, once you understand how UDFI actually works, it has a very minimal impact on your overall investment outcome. And here we've got a couple of those bullet points with some more detail. What some of the features of the QRP 401k versus an IRA-based structure. However, we do not want to run afoul of the requirements to have the checkbook QRP. And while any kind of qualified retirement plan can be checkbook controlled, in practice, these are only administratively feasible for owner-only businesses. The moment we have a business that's not owner-only, the fees to maintain that climb incredibly. So while our clients are paying $150 per year to maintain their checkbook QRPs, if they were to have employees or not business owners, the cost would just be substantially higher. So to qualify for a checkbook owner-only QRP, you've got to have an active trade or business, which generally does not include real estate rental income. So having rentals or having LP investments will not qualify you for a QRP. And we've got to ensure that you do not have those full-time employees that are not business owners. So I'd like to kind of conclude the presentation with this and then open it up for questions. It was kind of a lot of legal nuance here, a lot of different stuff that we've tackled. It's been broad and deep, and let's take those questions. Let's bring them on.
Great. So we have about 15 minutes left to be able to take as many questions as we can during this time. And for those of you who might not get all of your questions answered, you can, on the screen there, see Bernard's contact information. So go ahead and jot that down so that you can reach out to him to have those questions answered. So let's take the first question here from David. It says, I have a Checkbook Solo 401k, which I set up as an LLC under my real estate LLC. I was told that I don't need to report the IRS if my assets are less than 200K. Does that 200K refer to my investment dollars in the real estate I purchased within that Solo 401k, or does it refer to the value of the property I have purchased?
It's going to be based on the asset value. So not on the level of your contributions, it's going to be on the value of the asset. So if you did well and the value of the asset increases, then you can hit that reporting threshold. Incidentally, it's not 200K. That reporting threshold was 250K.
Great. And let's see here. Press the button there. Kimberly has a question about disqualified investors. The business partners aspect confuses me. I understand that I cannot use my IRA to invest in a company based on ownership with unqualified people, but can I invest with a company that is owned by an unrelated third party with both my taxable business and my IRA? Unrelated investments, of course, one deal with the IRA and one deal with my taxable business. Is that an issue?
So I hope I followed this question, and just to ensure it gets answered, I'll try to answer it broadly. This is one area that I see tripping people up all the time. So in the list of disqualified persons, where everybody got the family members, those kind of blood relatives or legal relatives covered. However, business partners, folks that you have business ventures with outside of your IRA are also disqualified persons. And custodian questionnaires, custodians, when they fund deals, they also want to make sure that they don't fund any prohibited transactions. And the standard questionnaire will ask, is your mother involved? Is your father involved? Is your child involved? Business partners tends to fall between the cracks. So if somebody is your business partner in a venture that you've got outside of the IRA, they are a disqualified person to your IRA.
I don't have any other further questions in here, but I do have one myself that I wanted to ask you. So if somebody, let's say there's an offering out there and the minimum investment is say $50,000, but they only have $25,000 in their IRA and they want to invest $25,000 in cash, can they passively invest $25K of just regular cash in that deal as well as $25K from their IRA?
That is an excellent question, and we would discourage that. When there are hard minimums and there's benefit crossing between the IRA and the individual, if there's a clear benefit, then we would discourage that.
And so what would be the benefit there, the ability to actually invest in that because you're able to pool the resources?
That's right. So, of course, it's very much facts and circumstances. So if that person can demonstrate that, hey, I had the assets, either I had $50K in my IRA or I had $50K in my bank account, but I thought that for my tax planning, my long-term financial strategy, that this is just a great deal for my IRA and it's a great deal for me. So I figured let's break it up. That's cool. But if they're really cash strapped and the only way they can do it is by pooling those assets, that's something we would discourage.
Okay. So that'd be a great question to make sure that you would, had your CPA or something like that, kind of make sure they're looking at the actual situation at hand and making sure it's all up and up, if you will.
Yes. It's one of the things that we want people to be aware of is that even when you've got that control, there are still rules that you've got to follow. And you want to be cautious. Now, when anything tax related, nothing happens unless you're audited. But in the event that happens, the adverse consequences are not something you want to deal with. So rather be safe than sorry is our approach.
So this next question is from David. My LLC that owns the Solo 401k has a house which it owns and is rented month to month to guests. The company pays me and my wife a management fee. Is my 401k legal?
That is an excellent question. And I'd probably prefer not to answer that on the air and live. But this is an issue that we are encountering. Now, there are ways that you can structure things in order to kind of qualify for a QRP, right? A 401k is just some version of 401k, and a QRP is an employer-sponsored business. By its very definition, it's written in the tax code in Section 401. It's something that's a trust that's created by an employer. And the kind of income that qualifies is going to have to be the kind of active trade or business. So rental income is generally passive, right? There's no self-employment tax on passive income, on rental income. So that generally does not qualify. When you can take steps to create some sort of management structure with management fee, management compensation, but it has to be well structured. Simply calling part of your LLC income management fee is not going to do it.
Okay. Next question here is from Troy. He said, isn't the UDFI tax substantial on a large gain from a sale?
Okay. Awesome question. So the UDFI, and the UDFI can be meaningful. It depends very much on the magnitude. But one of the things that I've been hearing recently is UDFI rates are, 40%. The UDFI rates on a sale are the long-term capital gains rates, right? So we're not looking at any of that 40% stuff. We're looking at 0, 15, or 20%. So once we understand that is the rate we're dealing with, and then recognizing that the tax is only applied based on the ratio. It's called the debt basis ratio. So it's not going to catch all your investment. It's only going to be a percentage of it. Then you'll find that it is generally nominal. And when I say nominal, of course, on a $100 million deal, it's going to be a big number. But in the scope of your investment analysis, it is not a factor. So for people that are investing in real estate, right? If we're having somebody that walks through the door and he says, okay, should I use my tax sheltered accounts for real estate? Well, the first thing we're going to try to see is, okay, can we qualify these folks for QRP? If not, then we're going to go to the IRA-based structures. And if we have to use an IRA-based structure, then the analysis becomes, okay, do you want to keep your IRA in the stock market or put it in real estate? And yes, in the stock market, you're not going to have UDFI, but you're not going to get leverage either. So you try to go to your bank and say, okay, I've got $200,000 in my IRA, and I'd like to buy $800,000 of stocks. Let's see how that goes over. Whereas in real estate, you actually get the benefit of using the bank's money. You want to do an all-cash deal, you can do it. You can do all-cash real estate, or you can use leverage. You will always come out ahead if you know what you're doing in real estate. Of course, there are good deals and bad deals, but anybody that's doing this is planning to do good deals. And on the good deal, you're coming out way ahead, even once the UDFI is factored in. So the UDFI is never a factor in your decisions, because you could not choose a QRP over an IRA because of UDFI. You choose a QRP because you qualify for it based on your financial profile. If you don't qualify for it, then you don't want a QRP. And of course, if you do qualify for it, then we get you set up with the QRP. But once you're in the IRA world, the UDFI is something you'll have to contend with potentially. However, it's generally not going to be something that's going to impact your decision or your overall better outcome that you're going to get with real estate vis-a-vis mutual funds.
So the next question here is there a process one could follow if they have a checkbook IRA invested in a syndication and are now able to meet the QRP rules? Could they migrate that to a QRP while it is still invested in the syndication?
Yes, they could. That's called an in-kind rollover, and it absolutely is doable. Requires paperwork, but that's doable.
Okay. And let's see. Next question here is what is considered earned income to be eligible for a solo 401k contribution, investment income, interest, etc.?
Right. So those that are mentioned there are not considered earned income. Earned income is something that would kind of rule of thumb, a way to understand it and to look at it is to know, would I pay self-employment tax on this income? That's a good rule of thumb to use. And anything that's investment is generally not that kind of income. So it's going to be something that's a business. And now it's important to note, say, what is a business? And let me bring the slides back up for a moment. Am I still sharing my screen? Yes, I am.
Yes.
All right, so let's take it back a minute. Okay, this is actually the last one that we skipped. If I only work part-time in my business, do I qualify for a checkbook 401k? The answer is yes. There's no requirement that it be a full-time business. However, it's not something that you do once and then forget about it. So it can definitely be part-time. Question, I have a W-2 job. Can I have a checkbook 401k for my self-employment income? Again, yes. To take it a step further, I've got a W-2 job and participate in my employer's 401k. Can I have a checkbook 401k for my side gig, my self-employment income? Yes. So as you can see, what I say generally is, with today's side gig economy, more investors than ever qualify for a checkbook 401k. Because it can be a side gig, it can be a side hustle, it can be consulting, it can be ride sharing, it can be so many things. It can be selling stuff on Etsy and Uber, selling Etsy and eBay, Amazon. There are just so many options that are available, and more Americans than ever are engaging in these side hustles. However, it still holds true that most Americans probably do not qualify for the QRP that's owner only. Because we're looking for the subset that have an active trade or business that's a true business, not an investment, not an LP investment, not a syndication, not having a duplex that they're renting out. So they've got a business, but it has no full-time employees. So there are tens of millions of Americans that definitely qualify, but there are probably more that do not. And I'd say a key focus and key benefit that we bring to people is say, hey, we do all plan types. We're not here to promote one over the other. We know all the pros and cons and the drawbacks, and we're going to help guide you to the one that suits you best.
All right, that is all the questions that we have for today for this particular session. Bernard, I want to thank you so much for joining us and participating and sharing a lot of this information about the Checkbook 401k.
Yes, Dan and the entire multi-family investor nation. Always great to be here. Love sharing the knowledge, interacting, networking, and everybody is welcome to hit me up if they've got questions, email, phone number. It's all right there. Wherever you are in the country or all over the world, we'd love to talk to you.